So you're faced with the ever-present decision. Do I go with a fixed rate? Do I go with a variable interest rate? Depending on when you're watching this video, we could be seeing a situation where fixed and variable rates are really close, and there's a lot of pressure to figure out which one to take, or we could be in a situation where they're far apart and it's a really obvious decision. But here's the deal. It's never really an obvious decision, because the reality is it really comes down to your personal financial situation, your comfort level, and then of course what's happening in that economic environment. So I built out a 7-part framework to figure out exactly, should I be taking a fixed rate or should I be taking a variable rate? Let's get into it right now. All right, so let's start off with the simple stuff. If you don't know the difference, fixed rates and variable rates, fixed rates remain the same. Variables can go up and down based on BOC, Bank of Canada's decision to increase or decrease variable interest rates. That is because if they increase the overnight rate, then prime goes up and so does your variable rate. If they decrease the overnight rate, then prime goes down and so does your variable rate. But here's the catch. In some circumstances, you could take a variable rate where you actually pay the same payment, it just more or less goes to interest. But let's, for the sake of conversation, assume we're talking about payment stability or instability. Here's the question you want to ask in step 1 of the framework. Number 1, do I prefer stable monthly payments? That's it. Not overly complicated. Do you want payments to remain the same month over month because you have concerns, or you can't sleep at night because those payments could change next month or 6 months down the line? If the answer is yes to that question, then right away you know that you are probably leaning more to stability. And that doesn't necessarily mean a fixed interest rate, but it means a fixed payment. The second part around stability, I know everybody could handle interest rates going down 2%, but could you handle a worst case scenario where interest rates also went up 2%? And the answer to that question is not something that you just check a box. Pull out your mortgage calculator. If you don't have one, you can go to my website, getflowmortgage.ca. There's a calculator that you can download, or you can check the link down below. Have a look at your mortgage and add 2% to it. Could you get by if those payments were 2% higher? If the answer is no, again, volatility is not there for you, my friend. Listen, nobody wants to pay interest rates of 2% higher, but you should test to make sure that you could find a way to get by. If the answer is flat no, then definitely don't go variable. Step number 2 is all about risk tolerance. Where do you stand as it relates to the amount of risk you're willing to take? Here's how to think about it. It's really simple. 0 out of 10, no risk at all. I put my money under the mattress in a savings account, even if it loses value to inflation. No risk, nothing. And I would argue actually that's very high risk, but different conversation. 10, you got lots of risk. Very comfortable with daily stock markets going up and down. You'll play with your money. You might even go to the casino and gamble that money. Truth is, most people are not a 0 or a 10. They're usually somewhere between a 3 to a 7. So the question mark for you today is, how far along that line do you fit? And don't say 5, because the honest truth is nobody is actually a 5. They're usually on the higher end of the scale or the lower end of the scale. They're just not willing to admit it. So be honest with yourself. Would you do a little bit more risk for a higher reward, or lower risk for less reward but more stability? That is number 2 of the framework that you'd want to consider. The second part to that is, if you are someone who has a medium to a higher risk, so let's just say not a 5, 5.5 to a 7 or an 8, then you have a greater amount of risk tolerance, which means you would like more reward. And chances are you'd be okay with a variable rate. So in this case, type yes, I'm comfortable with risk, as opposed to no. Step number 3, equity and emergency funds. If you're taking a fixed rate or variable rate, one of the key questions that you have to ask, and obviously this doesn't apply to everyone, is how much equity do I have in my property? Okay, equity is the difference between what you owe and the difference between what your property value is today. So if you bought your property and it was worth $1 million, today it's worth 1.5, and you only owe $500,000, you have $1 million of equity. So you have a lot of wiggle room. That means that you have more room if things go sideways for whatever reason, both in a fixed rate or a variable rate. The second, related to that, is your emergency fund. So if you do not have any equity in your property because you just bought it with 5% down, do you have a backup plan? Do you have $15,000, $10,000 of emergency money set aside that you can cover your mortgage payments for the next 3 to 6 months? If the answer to that question is no, again, you should probably not look for volatility in your life, but a little bit more cost certainty. But if you do have an emergency plan and you do have some equity, then you definitely can consider going variable for that reason and that reason alone. Okay, number 4 is a big one. What are your plans? What are you going to be doing in the next 3, 4, 5 years? Heck, 2, 3, 4, 5 years. A big part of going fixed or variable is not actually the interest rate itself, but it's the penalty. Here's the thing. Most people don't stay pat. The average Canadian barely gets through 3 years on their average mortgage. And that might be part of the reason that 3-year fixed rate mortgages have been so popular. That and the fact that the interest rates are there and people were expecting rates to come down. But with all that being said, if you have volatility in your life, meaning You might be in a position where you could have a family and have to upsize, change jobs, move. Maybe you want to refinance to get equity out to go invest in another property. There's a whole bunch of different reasons for someone to make a move or make a change. And in those situations where they might look to make a move or a change, they would be better off to have flexibility in their life. And this is really important because if you take a variable rate mortgage, you have 3 months worth of interest that you would pay in terms of a penalty and nothing more unless you took a restricted mortgage. Look out for those. They're around. They usually have lower rates and they will have higher penalties. Anyways, fixed rate mortgages, whole other animal. You could be paying an interest rate differential penalty, which is basically like a way for a bank to recapture all of the potential interest that they lost if you left them early. It's like a really crappy return policy where, yeah, we have 30 days return, but we're gonna charge you back 50% of the cost of the product that you bought. Like, it's not ideal. So if you're someone who might have flexibility in your life, and I would argue that's probably a lot of people, then you'd probably take a yes for variable and a no for a fixed interest rate for that reason and that reason alone. All right, let's talk about affordability over an extended period of time. Could I manage an increase in my payments? We talked about this earlier, if you could increase your payments by 2%. Now, the next question is, could I manage an increase in my payments for 18 months or more? Okay, in 2022, we saw the Bank of Canada raise interest rates pretty significantly over the course of the next year. And rates remained elevated for almost a year and a half, putting the squeeze to a lot of families who were stressed out with higher monthly payments. Now, in that circumstance, again, rates didn't raise 2%, they raised 4%. So if you want to test your budget at a higher number, feel free to do so. But keep in mind this, either way, if you're testing rates at 1%, 2%, or 3% higher than the market, are you testing it over the course of 18 months? Could you make that work without losing your property, without having a default in an emergency situation? The answer is no, then you're probably not okay to take a variable interest rate because of the potential changes of that is. Now, remember, I'm talking about the potential worst case scenarios, but that's the best case scenarios. I should tell you all the bad things that can happen, because if you know that, then you're probably gonna be well aware going into it if you should go fixed or variable. All right, here we are, almost at the end of the line. Step number 6, and this is a big one. And it's really challenging for a lot of people to understand this. It's the rate cycle position. So here's the deal. Interest rates work in basically rate cycles. They don't just go up and stay up forever and go down and stay down forever. They go up in cycles, and there's typically a level of a rhythm to them. A look at cycles over the course of history, there's usually a lot of similarity. And here's the thing, while there are no guarantees at exactly how much rates will go up or go down, and exactly when, there are certainly a lot of signs of likelihood as to when they could, particularly as it relates to changes in the economic environment. Case in point, inflation goes way up. Well, best believe we're going to see the BOC, in this case, the Bank of Canada, increase interest rates, increasing variable rates. Inflation starts to go down, business is not doing as well. We'll start to see the opposite occur. So where are you? If you're at the end of that rate cycle where rates are down, probably not as ideal to go with a variable rate mortgage. If you're in the beginning, not the worst thing ever to go with a variable rate mortgage at that time. Know where you are at that rate cycle to put yourself in the best position to be able to proceed and move forward. And this is the biggest one of all, in my opinion. You've tested yourself out, you know how much equity you have, you know where your comfort level is, you know what your market volatility is, but do you know what your employment future looks like? You have a stable position. Are you a police officer in a position where you're probably going to continue to get paid, and you're probably going to get paid more year over year? Or are you a business owner of a restaurant where the amount of money that you can make month over month could change, year over year could change significantly, therefore having a significant impact on how much cash flow you actually have to spend on things like your mortgage and any other expenses? Knowing your current employment position provides you with more certainty. Here's the interesting thing I've learned though. In my history, I find that people with more stable positions and a certainty of increases, funny enough, are actually looking for the more stable, even if it costs them more. And those who probably should get some level of stability often want the opportunity. I'm not sure what that says, but that's what I've seen historically speaking. So let's tie it all together. We're looking at risk factors, we're looking at your employment, we're looking at where the market's going, we're looking at all these different things. How do you make an informed decision? Keep it relatively simple. Check yes and no to the questions that I asked, and then make an informed decision after discussing with someone who's an expert. If it's not me, somebody who understands the marketplace and it can explain it and break it down. ChatGPT will only get you so far. Googling will only get you so far. Watching these YouTubes will only get you so far. You need to get some personalized, specific feedback after analyzing your portfolio. But if you're gonna do it on your own, then definitely do it on your own. Just make sure to subscribe to the channel so you get more of this good stuff, and we'll see you on the next one.